Welcome to the B.F. Anderson Technical Report for May the 16th. Well, look, let's get right into the market. I leave all the economic forecasting to the experts. I have to make a point. If anybody's seen the movie The Big Short, I thought it was very interesting that economic forecasting did no good for anyone. Not one economist that I know of predicted the 2008 financial crisis. So when it comes to economic predictions, be very careful. The tariff, everyone's worried about the tariffs and so forth. But as you can see here with the NASDAQ, we pulled back last week, very difficult week last week. However, we did it on, fairly average volume. It wasn't extraordinarily high volume. We pulled back. Now notice here how we get these corrections. You'll get a pullback, and then it'll form a low and then just rally again. Well, the good news here, in my opinion, is that we got the pullback, we rallied back, made a higher low. Now, as of yesterday, we made a higher high. So, optimistically, it looks like maybe the worst might be over here. Now, on a longer term basis, we're looking at a weekly graph of the NASDAQ, and we're using the 35-week moving average. The basic rule is as long as we stay above the 35-week moving average for more than 2 consecutive weeks, that's a buy signal, which we got several weeks ago, and we are continuing to hold above the 35-week. Now, as you can see, last week we did have more volume than the prior week, and we're still early in this week. We still have another 2 days to go. Now, on the advanced decline line, we are seeing basically a flattening out of the advanced decline line. Now remember, this is net advancers versus net decliners, and you get either net advancers or net decliners. Now for the last 2 days we've had net advancers, but as you can see here, 3 days ago we had the worst number of net decliners year to date. The high-low index, as you can see, we finally have broken down below the basing area that we had formed. We broke down below. Hopefully we stabilize in this area here and then rally. The new lows have picked up a little bit. We had 55 new lows yesterday. Now this is on the New York Stock Exchange. And as you can also see down here, our magic number is we don't want to see an extended period of time where we're getting more than 40 new lows a day. Well, we actually got above, for 2 days, we got above 100 new lows per day. However, things did settle down a little bit, and we'll have to keep an eye on that. Now, on a longer-term basis, and I really want to take a little bit of time with this graph, I got this graph, or this concept of using these moving averages. Now, realize moving averages are just a valuable tool because what a moving average does, it just takes out the crazy wiggles that we all know exist in the stock market. And this is a very long-term moving average. This is a 10-month moving average versus a 20-month moving average. Now, this idea came to me from a technical analyst by the name of Louise Yamada, who I have tremendous respect for. She's written several books, very knowledgeable. And basically what Yamada argues is that the way she defines a bear market is if you get basically a death cross where you get a breakdown below the 10-month breaks below the 20. So you can see back here in the bear market of 2000, you got the death cross, then the downtrend. You got the death cross, then the downtrend in the 2008, 2009 bear market. So if you look at where we are today, we're still in pretty good shape here. The index is above the upper moving average. The upper moving average has turned up. Now it flattened out a little bit, but not terribly. But we are in a basic uptrend. Now let's take it another step. Now what I've done here is to make a point. Back in 2008, 2009. We advised clients that we felt like the oil market was going into a bear market because we had a death cross in the price of oil. Now remember, the price of oil was over $100 a barrel. Then we got the death cross, and basically we got somewhat of a rally back up in oil, but then we got another death cross. Now we're getting another death cross. It really does appear to me that the price of oil is in a long-term bear market. Now let's look at one other index. Now remember, I've removed the price of the index. All I have here is the moving averages so that you can clearly see what I'm talking about. Now this is the PGJ, which is the Golden Dragon China ETF. Now, what this is an ETF fund of all the stocks that are based in China that trade securities in the United States. Now, you can see here we got a death cross. So this basically would say to me that the Chinese stock markets, or the Chinese stocks, should probably be avoided because it looks like they're going into a bear market. Now, getting into fear greed is kind of good news on fear greed. We have now moved into fear. It really is amazing how you get into this greed reading, and then we have the correction. So when people are getting too optimistic, it's really kind of a contrarian idea to just kind of become a little bit pessimistic and kind of hold on to not getting too aggressive. But we've moved back into fear. We may go into extreme fear, but so far we're just in fear. Now, we're also keeping an eye on another long-term indicator, which is the 200-week moving average, which the S&P, now this is the S&P 500, broke above the 200-week moving average back in 2011 and has pretty much maintained that uptrend ever since. Now, you'll notice these corrections that we've had. Here's one that right before the election in 2016, we had a correction, but then we resumed the uptrend. Then last year, we had a correction, and now we're resuming the uptrend. Now, you can see here we did pull back. Now, I do want to make a point on the all-time new high that we hit on the S&P, and I'll make that here, right here, by using the Russell 2000. Now, this is the small cap index. Now, one thing about small caps, this is the most lucrative area of investing in the stock market. Because if you really think about it, what you're trying to do is to find a small Apple computer, back in the early 2000s, when it was a small company. When we first found Apple, they had just invented the iPod. It was about a $30 billion company. Now they're a $1 trillion company. So you really want to find something small that can become big. It's just common sense. Well, the point I want to make is on the recent new high that we saw in the S&P and the NASDAQ, but just the S&P. If you calculate what percent of the stocks of the S&P 500 hit all-time new highs when the index hit all-time new highs, and it was only 9%. So only 9% of the stocks in the S&P hit all-time new highs of the index. Now, this is the problem with market cap weighting. The biggest companies are going to dominate the indexes. Well, I also feel that the small caps, which did not hit an all-time new high and are really pretty much a country mile away from it, the small caps have gone into a consolidation period here. Now, if you remember last year, which was a very difficult year, especially the month of December, which was the worst December on record, the small caps were the first stocks to break down and acted somewhat as a leading indicator. Well, as you can see here, now the small caps have gone into a consolidation. So, if we believe this is somewhat of a leading indicator, it would kind of mean to me that maybe the overall indexes, meaning the S&P and the NASDAQ, etc., they're going to go into a consolidation period also. Again, not predicting, just saying that if this means anything as a leading indicator, that's what it's saying. However, the good news here is that we did break out above 1,600, then we got our most recent correction. We made a low, which we held in this basing area. Then we rallied and we made a high, and then we pulled back, made a higher low, and then as of yesterday, we made a higher high. So what we want to see happen here is basically what happened back here. You make your low, and then you get back into an uptrend. But however, what would really, really be nice is if we could get back above that 1,600 on the small caps and see them start to trend higher over time. That would be a broadening out of the market, and that would be exactly what we're looking for. Now, on the Value Line Geometric Index, now remember, this is an index of 1,700 stocks designed to primarily tell you what the average stock is doing. So if you realize that the average stock hit a bear market in 2000, another bear market in 08, 09, and look how terrible that was, Then we rallied back up again around 2013, 2014, had another pullback. Then we finally broke out in 2016. Now realize here, this is about a 16 to a 20-year period where the average stock has really gone nowhere. Now, what I did here was I went ahead and said, okay, we broke out of this box for the first time really since 2000. And then we rallied, and then we consolidated, and then we really took off here, and then we pulled back, consolidated, and we rallied here, made a double top. Then we pulled back last year. Now, the point I want to make here is that we're seeing a pattern of lows, higher lows, higher lows, higher lows, and we were seeing a pattern of higher highs. Now, if you kind of just break this down into like some sub boxes, you can see that this 520 area is somewhat important. Because once you break below that 520, you can see what happened last year. However, so far we're hanging around 530 right now. If we could just get going again and break out and do just like I'm saying on the small caps, start trending up and make an all-time new high, this would be incredibly bullish. Now, kind of back to consolidations, as you can see, we get the blast off indicators that we've talked about numerous times. The blast off indicators in 03, consolidation, blast off indicator in 09, consolidation, blast off in 2012, consolidation, so forth and so on. We may be in the process of doing a consolidation here, which would not surprise me, especially the fact that the small caps are consolidating. So let's get into the top 5 stocks that, now realize these stocks are a watch list only. We're not suggesting that anyone buy. Now, we do own some of these, and I'll have to disclose that. But you want to keep an eye on which groups are the strongest. So what we do is we run analysis on a very broad sector of stocks, and then we come up with which ones are showing the most strength. Well, this is Enphase Energy, which is a company that's into microinverters for solar. And, who would think that solar would be hot, but it certainly seems to have something because the company's stock gapped up, gave a gap up buy signal, and hit an all-time new high yesterday. Now, here is Lattice Semiconductor. This is a very volatile stock, broke out with a big gap up, went into an uptrend, rallied to a high, and has now pulled back. Now, most of the semiconductors look this way. They're a very volatile group. ServiceNow, which is a software company very similar to Salesforce.com, that kind of thing. Now, what we have here is a gap up buy signal. When they announced earnings, stock went into a very strong uptrend, another gap up, and now it's consolidating again. So what we have here is what we would call a base on base. And then yesterday it broke out to an all-time new high. We own this stock. We like this company. It's a very good-looking company. Now here's a company that recently announced earnings, blew the numbers out the door, major volume rally. I mean, the stock rallied on volume of it looks like about almost 50 million shares, and it normally trades about 10 million shares. So it was a 5-to-1 above average volume day. Major breakout, gap up. Now, this is a buy signal, and we are getting some consolidation. However, we would like to see it break out again. Now, we do own this stock as well. Now, Roku, as probably most of you know, is probably the purest way to play streaming technology, which is pretty much replacing cable as people cut the cord. Now, here's another company that we own, a company called Shopify. They are involved in e-commerce. They announced earnings, major gap up. So you got a gap up buy signal. It has continued to hold the gap and looks very constructive. So all in all, things are looking okay. We had a difficult week last week. So if you have any questions, give me a call. Thank you very much.